let's start. So, okay, fair enough. I don't see. I see here the Bloomberg, which I don't want. Right. So, welcome everyone to this third meeting. I will start with a quick joke. This Conrad is like, yeah. The joke is, you give me your burger and I'll give you back half of the burger. That's a 50% return. Cool. So what do we have? Okay, you know me, I know you. Let's start with the game. So as always, think about a stock, and my stock is, let me get a pen. Actually, I've just seen that there are some board pens, so I'm going to take that board actually, because there is some board work today. I hope that you find it interesting. And my stock is, so here, name, stock, I'm going to put here price 5 p.m. price 6 p.m. And today, guys, if you have any question or anything, because we are more in a private setting, I mean, feel free to ask anything. Right. And my stock is one that is called Vertex, which I have no idea what this stock is. Price that is 202.41. Right. So there you have your name, then the name of the stock, and then price at, current price. Moderna 8% down, Zoom 5% down. Poor investors of Moderna. That's pretty much impossible to trade. Right, so you know the game. Which stocks are you choosing, Conrad, Joel?
So I'm still thinking, I'm going to go for the same one I picked last week, Lucid Group. Lucid Metals. Well, last week it did awful.
Yes, exactly right. Oh, this is nice.
I hope I'm to win it from there. You're going on down.
Let me actually put the ball. Yeah, I think it will work. I don't want to change the whole room. Yes, I'm close to. Cool. I need to put everything back. Right, have you got that? Almost. Cool. Next slide is, okay, group meetings. I don't have to explain here anything, you know everything. So yeah, I think we have a quite interesting meeting today.
Yeah.
So I hope that you find it interesting.
It's already up by a bit.
Good, mate.
It's already up by a bit, like it's 55.88 now.
Yeah, it has a bit of momentum.
Yeah.
Right, so mainly two articles, or two pieces of news. New COVID-19 variant of concern, Omicron. let's see what happens if I open this. Yeah, cool. So yeah, I have 3 articles. This one just says that Fed that wants to taper the bond buying program, and the Omicron variant, so has led the stock market to go down, I don't know, I would say between 3 and 8% for the past week, for the past 2 weeks. Hawkins comments, I will explain what this is later.
I think this is screen supposed to be frozen. It's supposed to be on the screen.
Thank you, guys. Right. So I'm not going to make it big then, yes. So yes, Omicron variant chief deliver 1-2 pounds to stocks. So now that's what I've just said. What does the next one? What does the next one say? I mean, it is in the same line. Moderna chief predicts existing vaccines will struggle with Omicron. I mean, that has yet to be seen, but apparently scientists are quite worried about the 30-odd mutations of the virus. So yeah, let's see what happens. I guess that people that are vaccinated will have some more chances of getting ill or going to hospital or unfortunately die, and even more if you are not vaccinated. But I guess, and I hope that vaccines do still work for the variant. And finally, what do we have here? Omicron threatens to intensify supply shortages and inflation, OECD warns. So yes, I mean, this Omicron variant doesn't help for economic recovery and doesn't help for the inflationary fears. So we have a good cocktail for a pretty dark times in the stock market, but we will see. You never know. I mean, COVID has been going on since March 2020, and stock markets have risen just as if they didn't notice any pandemic going on in the world. So let's see. And then, very important as well, Powell signals quicker tapering of bond buying scheme. So apparently the US Fed is starting to realize that inflation is ramping up, so they need to start about raising interest rates and taper the bond buying program. So as well, these are all news about stock markets going down, but we will see. Anything that you want to mention interesting that might have happened in the past 2 weeks?
I just thought about there's like the Turkish lira and that might absolutely tank because they won't raise interest rates.
Yeah. I mean, Erdogan's influence in Turkey's central bank has been pretty awful. So I actually, when I used to live in Brighton, there was a guy, kind of a posh guy, a Turkish guy that was kind of in favor of the Turkish government, and when Trump did something that made the Turkish lira go down, he said that, oh yes, this is all because Trump did something, so let's all go against Trump. But I did show him, what's the ticker of the Turkish lira? It is, do you know the ticker of the Turkish lira? Lira USD, yeah, TRY. So let's see, actually, maybe it's the other way around better. No, this one is the good one. So yeah, look at this. And the thing is that currencies always make me sad because this just makes Turkish people much poorer, or at least when they want to go abroad because their currency is worth less. In this case, if they go to the USA. So I did show him this chart. I mean, probably not as much as this from, let's say, 2000, but, or I don't know, 2010, and Trump wasn't there. I mean, he was in the USA, but he wasn't famous at that time. So I just did show him that Trump had nothing to do with the currency of Turkey, but its government and all those dodgy dealings with Erdogan and the central bank's governor. So yeah, let's see. I mean, look at this. It's so scary because what I've just said. Cool. Anything else? Conrad? Umair?
Yeah,
Yes.
oil prices.
Oil prices, yes, plummeting as well. Oil. I mean, the thing is that Bloomberg has so.
Yeah, it's very confusing.
So let's put here crude oil. Yeah, WTI, but I don't know if
No,
this. The thing is that the top parts are never the securities. They are kind of, yes. So yeah, here we go. Let's put a month. And yeah, so Omicron arising. That means that we people will probably stay at home more time. Will therefore consume less. Will therefore use our cars less, so less demand, so price down. Cool. Joel, anything?
No.
Cool. Sorry, Conrad, anything?
I mean, all I can think of is like the fact that Austria went into lockdown recently and stuff, and other European countries are kind of like thinking of doing that as well, maybe. So that's probably not going to bode well
Yeah.
for the market.
Absolutely. And yeah, Germany as well, and it's quite striking as well that a new COVID variant comes and suddenly many countries just block borders with South African countries, which is, I don't know, difficult to explain. But yeah, there we go, and I think it has to do maybe with the vaccination rates of Austria. So I guess that countries that have lower vaccination rates will suffer more and will think more of more strict measures. Probably, I mean, in Spain, I think we are doing quite well in terms of vaccination. UK as well, I think, is doing well. So yeah, let's see. Cool. Let's carry on, guys. What do you have next? Concepts. Yeah, very important. Tapering. Tapering is the theoretical reversal of quantitative easing QE policies, which are implemented by central bank and intended to stimulate economic growth. So the last two lines are QE. Don't confuse that with tapering. So yeah, tapering, the opposite of QE. And we do that to keep inflation levels down. And I mean, I chose these three words, tapering, dovish, and hawkish, because you will hear them very, very often. And they are quite important that you know. And I got that from Investopedia. Then dovish or dovish. A dovish policymaker will try to encourage a looser monetary policy, one that tends to increase the money supply instead of restricting it. So yes, someone that just wants to print so much money for the economy to recover or to do very well. But I mean, that has some negative consequences. For example, that inflation goes up. And hawkish policymakers will try to keep a lid on rising prices and wages by increasing interest rates, reducing the supply of money, and limiting the growth of the economy. I mean, that might sound bad, but I mean it's something that policymakers need to do when inflation levels just keep going up to control those levels. Anything about these three concepts? Cool. Market update: US markets 2-4% down, UK and EU markets 5-8% down in the past 2 weeks. So S&P 500, the 17th, last meeting, you're right. Actually people cannot see the room that we are in anyway. So we are here 17th, then 3 days after highest point, but then it's come down, S&P 2-3% more or less. Nasdaq, yeah, very similar. But the Euro stocks, for example, look at this, much acute drop. From this point to this point is probably a good 8% down, and FTSE 100 as well. As you can see, not this one, they touched and they went down the 200 simple moving average, but they closed the session just above the moving average. For any of you that are interested in technical analysis, and the same for the FTSE 100. Cool. Anything that you want to discuss, stock or index or anything? Let's move on. Cool. Virtual fund competition so far. Okay, you were not yesterday in the fund meeting. Any of you two? Okay, cool. You were there. Yeah, cool. So this is the main, I mean, all the portfolios. So we are the gray line. We are the only group that is positive. I will explain now the main differences of why we are positive and the rest of the groups are negative. So the fund managers groups, only stocks, no bonds, and all the positions down. We have that PayPal, Visa. I think we mentioned that 2 weeks ago, that Amazon doesn't want Visa's credit cards to be used in its platform. Connor, some Forex, which actually I think we were told that we were not allowed to invest in Forex anyway. And portfolio share 13%, that's a lot. But that is gold against dollar. But that's not Forex. I don't know why it says that Forex. Anyway, then several stocks, only waste management. Fair enough. Funny name. And then to crypto.
We should, sorry for interrupting, but we should buy gold because
A commodity.
It's a good hedge against. Like if you're expecting the market to go down, gold generally rises up when the market goes down.
Okay. Yeah, we could look into that. I mean, we could look into. Actually, you could look into a mining company. So
we can't just buy directly. Like, we can't just do this.
I think we were told no more of 5% of cryptocurrencies. Fair enough, they have more than 5%. I think no Forex. And commodities directly, I'm not sure, but probably we can do it well if we just buy a mining company. Then you choose if it is gold or, I mean, it won't be only gold. It will have more minerals, but yeah, it will move mainly based on gold, so that will be fine. So yes, if you can do that over Christmas and come up. I mean, you can do it next week, you can do it the week after the teaching finishes, or when you want. And I will put that trade when you tell me the company. Cool, next one. So next one is our group. Actually, let me show you that on Exante. Right, now Exante doesn't show. Why? Click trade, but now we cannot see the right part of the. Yeah, there we go. Yes. So this part are the bonds, which I will explain. I mean, today is kind of a bond seminar, so I will explain all of this properly. And then for stocks, we have Apple, we have Canadian Solar, Skyworks Solutions, and Pfizer. Yeah, Gabriel is not here, but it was in between Gabriel and you, the pharmaceuticals things in terms of COVID, or only Gabriel? I don't remember now. Okay, cool. So yes, I mean, look at Pfizer. We were lucky enough to buy the trade or to buy the stock before the Omicron variant came into the news. And yes, I mean, I really don't know what Moderna. Had we bought Moderna, if we would be making any profit or losses, I really don't know, because I mean that's been, I guess, a lot more volatile than Pfizer. But yes, I mean we kind of got lucky there with Pfizer. I mean, Omicron coming into the news, that means that the market thinks that we will need many more Pfizer vaccines, and hence earnings of Pfizer go up, and hence share price goes up more. Okay, in terms of bonds, I'm going to explain that a bit later. But yes, we are.
I have a doubt. We have a lot
So
of
actually,
bonds.
yes, at the moment we are 5,500, and here we were. So yeah, we are double that. So more or less it's gonna be, yeah, well, 0.30% up, something like that. Yes, Umair.
So we have a lot of bonds in the portfolio, but the problem is that we won't receive any coupon payments for the bonds at the end of the competition. It's like 6 months.
All the bonds here will be or will pay us a coupon within the competition. I will explain now and show when
So
the
all these are
coupons
like
will be
short-term
paid.
bonds, or how many? What is the time? Are these short-term bonds or like long-term, like 10 years?
Most of them are very long-term bonds. So it's just, so we have some bonds in the, I mean, you were in last meeting about the playing quite conservatively, and we do that by having a good amount of bonds in the portfolio. But yeah, I mean, let me explain everything about the bonds, and you will see many more
Because
things,
we're expecting interest rates to rise, then the price of them will go down.
but less than stocks, and that's the point.
No, but then I'm actually like for the next 6 months, I'm pretty bullish on stocks, because after every variant you've seen a very high, a good bull run. So I don't think the variant is going to last for 6 months. And okay, let's say the next 2 months we suffer from the variant, and after those 4 months, we'll actually see a very good return in stocks.
Yeah, that's a very good point, Umair, and that's why we have 200, actually not 200k, but 170k or so in stocks and 500,000 in bonds. And we have some cash, mainly for stocks. But yeah, I mean, your point is good, but I think it is important to have a big proportion of the portfolio at the moment in bonds. I really don't see the market going a lot more up. But yes, I mean, I see your point.
Okay, fine, we can have the bonds, but can we double down on the stocks? If like, can we buy healthcare? Can we buy oil? Can we buy tech?
Absolutely. Yeah. I mean, we have. Yeah, I haven't opened this. We have 316,000 euros left to invest.
Okay.
So, yes, I mean, we have money for more stocks. Absolutely. Cool. Anything else on that? Yeah, next. Okay. This is Archie's portfolio. I mean, he explained yesterday that he wanted to have kind of a fund or a mutual fund idea, so having many holdings. Actually, for one of the next meetings, it's interesting if I bring the how are they called? The kind of investor information page of a fund, which okay, this is in Spanish, but which tells you the number of what is it, holdings, or I mean the 10 biggest holdings and the number of holdings and the sectors, and I think it's quite interesting to analyze this document. I don't see now the number of holdings. Yeah, must be here, 114. So I mean, he's trying to do that. I think it's just a lot more difficult to control so many stocks, and actually this first stock weighs 5% in the portfolio, and the rest pretty much a very low weight, except this as well, 4% Deliveroo. So, and then a part of Bitcoin. I feel that I mean, I really don't know why he's doing this. I mean, you could do it, but it's very difficult to keep track of all of that. And again, for me, the most important thing is that you come up with an idea, a trade idea, you bring it to the group, and we put a trade on that stock. That's the most important thing. I'm pretty confident that out of those, I don't know, let's say 40 stocks, I doubt more than 3 or 4 of them came from their or his analysts. Anyway, let's move on. William is more reasonable portfolio. So 4 stocks, Palantir. I really tend to avoid, I mean, my years in the market, and I'm not saying that I'm an expert or anything like that, but my years in the market just have taught me that if there is a stock or an index that is falling down, just don't touch it and forget about it. There are thousands of more stocks in the market. So even though you think that Palantir, because it's very famous, or Tesla or something like that, is going down quite significantly, you will be able to make money there. I mean, I think it's pretty impossible. And the only thing that is very likely is that you will lose money, or you will. In those kind of investments, is that sentence that is very popular that says that a bad short-term investment becomes a long-term investment, or something like that. Because I mean, to get back, so I mean, look at this, 16% down. That's a lot. I mean, to get back that. I mean, if it is a volatile stock, but then you need to take into account, you should have put a stop loss. That stop loss probably should have been triggered. So you just need to forget about the stock, even though you might like the stock so much for whatever the reason. Just forget about it and carry on with other stocks. I mean, life doesn't end with a stock that you like that just has come down so badly, and that you are trying to make money from that. I mean, no.
Are you going to have stop losses on, or?
Yes.
What is it, like 5%?
I will explain everything now with the bond part, and that's a very, very good point, because I didn't explain that last meeting in terms of the stocks, which I probably should have. But right, the platform portfolio performance, we've seen it. My intentions, you three, were in the last meeting, and I think this is quite important. So rarely we buy stocks as we've done, or as I've done, which is you told me to buy Apple. I went to the platform. I went to Apple. I clicked the trade. I put, let's say, oh, I hate this. No, that's 1 million, so that has to be a bit much less. So more or less 350. That's 60. Can you see this? Yes, $60,000 more or less, 50,000 euros. A bit more, but yeah, more or less. And click buy, put a stop loss, click buy, and that's it. I mean, things are not done in that way. So how do we do things properly? It takes more time, but mainly first we use a limit order. What's a limit order? Before that, you've analyzed the stock and you believe that that it is a good buy at let me show you this. No, this is 1 week, so let me do one. So you think that Apple is a good buy at $120, not above that, because it's just not worth it. So we go to the platform, get to this one, and we put a limit order, market limit, yeah. Yes, this is not day, I remember this is, this happened other years. Anyway, it's one of these, because this one is, okay, buy the stock if it reaches 120, or imagine if it is now at 164, if today the price reaches 160, buy it. But we are kind of not interested in that. We are interested in do that for the next 2-3 months. If in the next 2-3 months the price reaches 120, you buy the stock. And that is how you make a trade, because you decided at what price the trade is interesting. It's not interested at 164, it's not interesting at 140, it becomes interested at 120 or below. Right, next point. You don't grab your 50,000 euros and you put a limit order at 120 of 50,000 euros. You split that in chunks. Could be 5, could be 10, could be 20. And what you do with that is you just make a mean price of what you want to buy. You could tell the platform, buy 5,000 euros or pounds or whatever it is at 120, buy another 5,000 at 117, buy some more euros at 116, right? And if the price goes down to those levels, the platform will make the trades for you, right? I mean, then of course the stock can go down to 50 and you would be losing so much money, even though you bought the price much lower than it is currently. But you mainly do that. You do it through a limit order and you split the big amount that you want to buy in different chunks. So you kind of, it is said that if you want to buy in this area, you accumulate a mean price in this area. Cool. Yes. And yeah, very important, as more or less I mentioned before, you might come up with a trade. I mean, not here, because here we will put the trade straight and whatever price and the 50,000 euros, and then we will get lucky or not with a minimum of reasonable. But normally you think of a stock, you study the stock, you decide the share price at where you want to buy it, but it might never trigger or it might never go down to those levels, and you might think, I wasted my time with this stock, but that's how things work, and you just need to carry on with the next stock. Cool. Yes. Anything on that? From your experience, or from what you've done, I guess that you probably have traded the market with real money at some point. So at the beginning, did you just go straight in the market and buy that with all the money that you had to invest, or how did you do it? Tell me quickly.
I mean,
How did you trade the stock or the cryptocurrency or whatever the asset you bought or sold? How did you do it?
I traded within the day, so I did intraday. So like I bought in the morning and sold in the evening.
Okay, but how much of the
quantity? So it depended on the price of the stock. So if the stock was expensive, then I used all my money. But if it was like a cheap stock, then I used half of it. But the quantity.
or the opposite? I mean, if it is expensive, you don't put as much money as if it is cheap.
No, expensive in the meaning like if it's a 2,000 rupee stock, a $2,000 stock versus a $50 stock. So.
Okay.
No, I'm not saying expensive like that.
I see. But I mean, in those terms, you could. I mean, because these trading platforms, they allowed you to buy not one of a share or whatever it is. No, okay, fine.
But I didn't have a lot of money, so I mean, I just bought whatever I could. I didn't.
Yeah, I mean, because there are some, I mean, not laws, but some principles that everyone should follow in terms of not spending much of, or let's say 1% of your portfolio on each trade, and if it is a risky trade, not spend more than 0.1 of your whole portfolio in one trade. You know what I mean?
Oh, I'm okay, but no, what I'm trying to say is that the money I had was very little, so I didn't care if I lost all of it. So I just put it all in.
Yeah, good.
It was not a lot of money, so.
Yeah, no, I mean, it's just for me out of curiosity.
Yeah, it was just
Yeah.
fun.
I just, like, probably some more volatile stock, the less I've got on it. So more volatile stocks, I put like maximum 5%, but then the kind of like the safer stocks, like, like probably some non-technology stocks, I put like 10% on it.
Very good. And congrats.
Oh no, I never traded because I value my money too much and I don't trust myself
Okay,
to put it on the market yet. So
good.
maybe
So, I mean, the day that you want to start with some real money, probably come to me and I can give you some ideas on how,
not lose it.
yes, more than get any money, don't lose it.
Yeah.
Cool. Asset classes, this is the same slide as last week, but yeah, mainly equities and fixed income comprise the two main asset classes. So this week, bonds. A bond is effectively an IOU note which promises to make regular fixed amount payments called coupons and a large payment at the end of the loan called the principal. Right, so let me start with an example because I think it's very important. I mean, fixed income, people don't tend to really understand them. So I'll give you an example which okay, but first, be careful. Despite being called fixed income, bonds are reliant on the borrower's ability to repay. The income is hardly fixed if you don't get repaid. And the bonds slides, I took them from the BMC course. Has any of you done the BMC course? Okay, no, probably not you. Oh yeah, good. So, example. Imagine, I mean, you might understand bonds, but I just want to make sure that you really understand them. So, imagine I'm a company and I need a new phone that costs £1,000, but I don't have the £1,000. So I go to you, Umair, and I tell you, can I borrow £1,000 from you? And if you give me the £1,000, I will give them back to you in 1 month, let's say, and I'll pay you, I don't know, £5 a week. So, what we have there? First, I will get the £1,000, so I can buy the phone, and I mean that example just could be to buy whatever machinery or whatever it is to expand the business. So we have a principal, which is the £1,000. We have the coupon rate, or the coupons, which are £5 per week. And yeah, this is an example without the bond price because it makes it kind of easier. So that's how it works. I get £1,000 at time 0. I'll give you £20 after a month, and then I will give you back, of course, the £1,000, the principal. But how is this price of a bond? Because every bond has a price, and when I talk about price, I talk kind of, it's not a share price, it's a bond price, but you need to understand as similar to what a share price does. It just goes up or down. So if I go back again to the portfolio and we take this Italian bond, so as you can see here, it trades as if it was a stock. It moves every day for whatever the factors. So let me take, so we have T equal, it's fair enough. I hope one of these, so we have the £1,000 at time 0, yes, time equals 0, we have the £1,000, and I won't go into the maths. If you want me, I can do it after the meeting. And then at, let's say, if this is T equals 1 month, we have here, I said, £5, and yeah, let's put here as well, £5. No, this tends to be at the end. So here £5, and here £5. So, how do we calculate the price of a bond? Any price of a bond at any moment. For example, the price of this Italian bond. So, what we need to do is, and here as well, yeah, let's do this. So we need to put, I don't know, you might have seen this, probably not you too, you will see it at some point during your university, you might have seen it. And it's about discounting all these amounts back to time 0.
We've done automatic foundations of funds.
Cool. So this is very important to understand because it's not just about bonds, it's pretty much everything. If you have a business idea and you need some financing to make the business running, you see how much you need, you see more or less how much you will earn after a year, then after 2 years, then if you maybe need more money, and what you need to do is to bring all those cash flows back to time 0 to decide if that is a good investment or not. Okay, so what we do is we bring these £5, which is, I mean, this is T equals 4, half, 3/4. So we bring this back to T equals 0, this, and this. I mean, not this one because we have it here. And this will give us a price, or will give us a number, could be 1,000 and, I don't know, close to 20. And that is the price of the bond, and that is the price that we pay for the bond. It's most of the times for bonds, they have a par value of 100. So instead of a £1,000 phone, it is £100 phone. But that is the main thing, the price of a bond. Like in any business, to see if that business is worth it or not, you discount all the cash flows, and cash flows are all these earnings and spending and all of that back to time zero, and see if the business is worth, or to calculate the bond price. And that is quite important to understand. Yes, then let's now do it through the same example, something that you will hear many times, but that it's not easy to really understand. And it's that thing that you will hear so many times: if the rates go up, prices of the bonds go down and yields go up. Yeah, that's wonderful, but if someone doesn't explain you with an example, you probably won't understand it. You might memorize it for an exam or for a course or whatever it is, but you won't understand it. So let's go back to the phone. Yes, and now we have a price, and let's say it's 100, the money that I borrowed from you. So I told you that I was gonna give you £5 each week, so 4 times. And that means that the that price of the bond is, imagine, 120, for example. But now, Conrad, you come to the conversation and you tell Umair, hey, I won't give you £5, but I'll give you £6. And Umair will say, oh, I prefer your bond. Why? Because you will pay a higher coupon to him. So what happens to the price of my bond? Because there is another bond in the market that is better than me, that has come after my bond was kind of raised in the market. The price of my bond goes down. Okay, and understand that price of the bond similar as a share price. If the share price goes down, if the stocks that you have, if the share price go down, you will lose money. So the same for bonds. In that case, my price of the bond will go down and I will lose money. So when we say rates up, it means that someone else has come with a better rate, and this rates up is mainly central banks raising the price of the money. All right, so that's why the rates go up, because kind of a central bank has risen them. Then prices down, the price of my bond, so bonds before that rise in the interest rates. Okay, don't confuse with things before the rates go up and after. Okay, because the price of your bond, you will get a price, imagine 124, something like that, because now you pay £6, so 6 times 24. I mean, it's not exactly that, because with the mathematical formula, you get, I think, a bit less, so imagine 4.98 or something like that, but yes. And finally, yields. Because I'm giving you £5, you will get some yield of your investment. So you will get the £1,000 back after a month, plus the coupons. So you will get an interest for your £1,000, because you, after a month, you will get back £1,030, something like that. But what happens that someone else is coming with a higher yield? Or actually, what happens if someone else comes with a higher rate than the yield of your investment will go up, but not mine, okay? Understood, guys?
Yeah, more or less.
Always bring it down to a simple example. So forget about the market, forget about central banks. Just imagine that you borrow some money from a friend, but that someone else, another friend of yours, needs to borrow more money and you don't have more. So you will say, oh, I prefer Joel's money rather than Conrad's. Okay? Cool, let's carry on. It's 6 minutes past 8. What do we have left? Okay, so we have yield. No, actually, let's explain this. Explain bonds. But yeah, at quarter past, let's start with the end of the game and the Kahoot. Cool. So, just Excel. This is stocks, bonds. So, in terms of bonds, what do we have? So, an Italian bond that matures in 2033, a Norwegian 2024. This is kind of a more short-term one. But what I did here is just take some bonds that are pretty different, so I could explain you more things rather than if I just bought the same kind of bonds. So in terms of maturity, you just need to know that the longer the bond, the more yield you should get, because you are taking more risk, because you don't know if that government or company will be able to pay me back what I lend to that government or company. Okay, so for this 2024 you should get a lower yield than a 2033. Then of course there are more factors, but in terms of the maturity date of the bond, you should get more the longer the duration of the bond, which another day we can go into duration. But yeah, and I will explain now about the yield curve, which is something that you will hear many times, but as well it's not easy to really understand it. Then, I just put here, we have the first 4 ones, government bonds, then these ones are corporate or company bonds. Icing is, again, something very important. This is the ID of any financial asset. Could be bonds, could be stocks, could be crypto, could be anything. So every asset, every financial asset has an ISIN. Then rating.
The first bond, Italian bond, it's 2033, right?
Yes.
And it's paying only a coupon of 2.45 with an yield of 1%. Isn't that with a rating of BA? Isn't that not? I mean,
not very good.
Yeah, it's not a good.
I mean, in general.
Because the Norwegian one is just 2024 is paying a coupon of 3 with a higher yield. Plus it has a better rating also. So I think instead of the Italian, if you could just buy the Norwegian bond twice.
Yeah, I see your point. I mean, the Norwegian government is not backed by the European Central Bank, and that's why. But yeah, I mean, I see your point. But again, it's important to have a variety of assets. So it's not just, oh, okay, this one is paying me more money or has a higher yield. Let's put everything in that Norwegian bond and sell the Italian bond because its real rate is negative. I understand your point, but that is what diversification is, okay? Right, rating. So again, these are S&P's, Fitch and Moody's ratings, so they classify bonds and companies. They tend to work in terms of the higher the rating, the more secure the investment is and the lower the yield that you get. But for example, in 2008, in the financial crisis, financial assets that were rated AAA, so the best rating, just bankrupt or went to zero. So just be careful with these things. Then currency. So again, different currencies. I could explain this because it's quite important as well, but probably another day. But the main idea is that if we have pounds, or let's say we have euros, and we buy something in dollars, so what happens with that? So imagine the euro strengthens against the dollar, and you might think, I mean, after we bought the asset in dollars, and you might think, yes, because our currency now is stronger, my investment in dollars is going up. So no, it's completely the opposite, because once you buy the asset, your asset is in dollars. In that case, if the value of the euro goes down, the value of the dollar goes, if the value of the euro goes up, the value of the dollar goes down. So your investment that is in dollars goes down, okay? And it plays a very, very important role. It's something that people or kind of beginner investors don't take into account. But the euro US dollar going from 118 to 113, which is right now more or less, that will or that can have a big that might make a big difference to your overall performance. Then coupon. So actually, yes. So I look for bonds that have coupons within the competition, and this means that this bond will pay 2.45% of 50,000 euros the 1st of March next year. So that's 50,000 times 0.0245. So 1,225 pounds. That bond will pay us. So again, the higher the coupon, the better the investment, but you reach a point that if the coupon is very high, that might be because the company is in trouble or the government is in trouble. So for example, Venezuela right now might be paying a massive coupon, but do you think you will get your money back after a year or 2 years? So that's you are nodding like no. So that's why you always need to, or you always have that trade-off between yield or interest and risk. Then yield to maturity. So this again an important concept. It's 13 past. But yield to maturity, this yield is the interest to maturity per year of the bond. And that means that once you buy the bond, you will pay a price, you will get coupons until the maturity, and if you buy the bond and you keep it until maturity, could be 1 year, could be 1 month, could be 30 years, you will get in that investment 1% annually. Now, if you trade the bond, if you buy the bond now and you sell it in a year, you should get that yield to maturity, but if the price of the bond goes down 1%, you just will get 0% after a year, okay? But yeah, very important. That yield to maturity is important if you are going to keep the bond until maturity. Number of units bought. This is not important. Number of units or number of, let's say, units of bonds. Amount invested, except this one, because as well I said yesterday that it's not easy to find bonds that the minimum trade is at least 50,000 or less. I never remember which one. Okay, so if we go to instrument info, here minimal trade size, most of the bonds in ex-ante are, I don't know, 100,000, 200,000, so we are not interested in that, and we cannot split that lot So we couldn't buy 0.1, so we would be below the 50,000 euros. Price bought, just the price at which we bought the bond, and the coupon date. And quickly, because it's 15 past, let me explain yield curve, a plot of time against yield. The yield curve naturally slope upwards to compensate lenders for the greater risk of long-term loans compared to short-term bonds. So we have here, and what is this? Let me write this again. So we have, this is time, and this is yield or interest. I mean, if you understand interest better, let's say interest. I mean, I tend to understand interest better than yield. Anyway, so this is present time, so t equals 0. And then we could have here, let's say 1 month, 1 year, 10 years, and could be 30, but could be 50 years. So what is this? Or how do we make the famous yield curve? So we start, let's say 1 month. So what is the rate that we get? And actually, let me say something before. You have yield curves of any asset. It's not just, or any, let's say, bond. It's not just about, I mean, mainly when you hear yield curve is the Fed's treasury, the US treasury. Yes, but you have yield curves of any bond. So for 1 month, let's say it's 0.5%. So we have here 0.5%. Here we have 1. Here we have 1.5%, 2%. So for 1 month, it's 0.5. Forget about the Fed's or the US Treasury bond. So in between you and me. Then for 1 year, because you will get your money back further in time, I need to give you more. So you will say, oh yes, I will accept that. So let's say it's 1%. In 10 years, you will say, I need my 100 or 1,000 pounds back as soon as possible. 10 years, yes, I could give it to you, but you need to give me more interest. And you say, okay, 2%, you accept 2%. Then 50 years, 50 years, who knows what I'm doing in 50 years. So if you want that, you need to give me 5%. So it's more or less here. And that yield curve is just kind of connecting the different points, and this is the famous yield curve, okay, which you can see here for the US Treasury. We could discuss why this is, and we could discuss why this is, because I mean, as I have said, you should have an upward slope throughout the yield curve, and as well you could have a curve that is horizontal, you could have a curve, or the famous inverted yield curve, which goes from, or let's go something like that, which feels very counterintuitive, but I mean as well this has, you can explain why you can have an inverted yield curve. Any questions?
How is that possible? Inverted yield curve?
It's to do with uncertainty, that markets don't know what's going to happen in the long term because of uncertainty, because of COVID, because I don't know, a war, or because whatever. So you pay more interest. You pay more interest here rather than here because people just don't want to. I mean, people don't want this, but not because this then should be much higher, but just because they don't trade this part.
Yeah.
All right.
It's a sign of a crash, market crash going to. Like in 2008 also, it's been what?
Yes. Yes. Has to do with negative outlook for the next, I don't know, 1, 2, 3 years. Cool. Right, Joel. So Joel came up with 2 trades, Skyworks Solutions and Canadian Solar. So if you want to explain us a bit this.
Okay. Skyworks is just a semiconductor manufacturer, so it's quite a quickly growing industry as a whole. It's used in like electric vehicles and like mobile phones and everything like that. So Skyworks is like relatively cheap for like current price to earnings anyway, and they have a reasonable outlook of growth over the next few years. So like the forwards, like for forwards price to earnings is fairly cheap as well. They've seen like good recent growth in like the bottom line and profit as well, and they've got some like really big customers, including Apple and Google. So it's quite a large proportion of their revenue streams are quite stable. And current ratio of 2.52, so they're not going to go bankrupt anytime soon. It's fairly positive guidance for the next quarter. So if they hit it, it might be quite positive for the stock price.
Cool. Very good. Very good. I brought this current ratio, liquidity ratio. Current ratio is a broad indicator of a company's liquidity, and a ratio of between 1.5 and 2.0 would be considered prudent. However, the appropriate size of the ratio depends on the nature of the business and thus the extent of trade receivables and inventory held. A high current ratio is not necessarily a good thing, and it may indicate a level of inventories that is too high or cash that could be used more profitable. And I took this from the IMC. So yeah, I mean, this is another ratio that you can use, but you need to see the cons as well of that particular ratio. Very good, Joel. Very good. Right. So that is more or less what I want you to do. For example, with Apple. For example, with I forgot your no. The new ones. Oh yeah, a mining company. Yeah. Cool. So let's check this quickly. Mine was, and let's do a Kahoot, and we should be done in 10 minutes. Right. Vertex. Need to see what that is. Oh, 1% down the Nasdaq. I think we're gonna be in red. Everyone is gonna be in red. 721.32. So let me calculate the difference. So 1.32. Yeah, right. The percentage change. So 1. So that's a nice ability of writing upside down. 241.
Sorry, 0.6.
0.6 first, yeah. Cool.
I'm trying to do last one for this one.
And actually, let me start running the. Okay, so at the moment I'm winning. Yes. How about you, Joel?
Awful. Minus 2.8.
Oh, yeah, good.
It was going to go either way. It was at 5% for the day. So
Okay.
it was going to go either way. Really bad or really good.
Yeah, that's a good point. Cool. So let me go for the Kahoot. Right, guys, and I mean there could be so many things that I could bring to the meetings, and I could be here speaking probably for hours. I will need a rest from time to time, but I mean there are so many things that I could speak about, and yes. Cool. So
0.07.
today nobody gets a prize. Oh, only maybe in the Kahoot. No, or maybe not. Someone will get a prize. Cool. Amazon.
0.07%.
Nice. So let me run this. Where are my Kahoots? Here. So yeah, grab your phones. No, I was gonna say I want to play. No, because I mean I don't think I know all the answers, but yeah, play. This one is the group meeting 1st of December. Yes. How many players are you in your Kahoot? Continue. Host. Classic. So the number, yeah, should come up now. Cool. I'm going to keep this. Well, the thing is that shows how volatile the markets are at the minute. I mean, the VIX is well above 20. So, cool. Umair, you 26. Cool.
Yeah.
And you out. Let's start. This one, this Kahoot is not easy. I don't think it's easy. Maybe yes, if you paid attention. Right. First question, as always, which is not easy, because I mean more or less if you know where the index is, you might have an educated guess. Yeah, I mean you were close. That could have been one of the possible answers. Next one. Nasdaq. This one is kind of new. I didn't have this index last meeting, and this one also is not easy. And I didn't show the index. No, I don't think I showed the index today. Yeah, nobody got that right. 1679. FTSE 100, maybe you know this one a bit more. Oh, but there are two values there that are tricky. Yes, those two, the 1793 and the 6981, were the Joel. Well done. Now, which team is the winning? Since the winning team in the competition. Yeah, cool guys. Who was the fastest one? I don't know. Anyway. What is tapering? Let's see if you paid attention, or maybe you knew that before. Tries to stimulate economic growth, a bond buying program, a QE policy, but yeah, none of the above. It's kind of the the economy is already very, very stimulated by QE programs and interest rates very, very low, and tapering is one tool that central banks have to keep inflation rates down. So kind of to suppress the economy, but in a good way, because inflation levels should be around that famous 2% and not above that and not below that. Next one. Nice. Oh, you have a... What is a dovish policymaker? Yeah, this one was easy.
Oh my god.
You got that wrong unintentionally. Good. Yeah, the other one was probably the easiest one. And what is a hawkish policymaker? You thought that was the right answer. Yes, none of the above. Again, hawkish is, policymakers that try to keep inflation rates down by raising interest rates, not lowering them. What is happening right now and what the Jerome Powell is trying to do now, in my opinion, a bit late, but that's only my opinion. A limit order. What does a limit order do? What is it? Yes. Limit order could be to buy or sell a stock. I didn't speak about stop losses, and I think it's quite important. If you want me to explain it quickly in 1-2 minutes, I can do it. If not, so yeah, limit order could be to buy a stock, to sell a stock, and I don't know what the last one, but yeah, none of the above. 2 more. A fixed income asset always makes payments, tends to be more volatile than stocks, tends to be less volatile than stocks, none of the above. Very good, guys. I like that, always and tends. And finally, the yield to maturity is expressed in months, quarters, days, none of the above. Always. Never make a trade without a stop loss. So, I have it here. It is kind of a... I don't think it's kind of law or anything like that, but it's a good approximation that for... Yes, and that is 10,000 is... That's 10% of the trade. Let me think about that. So, yes. So a stop loss we need to put. So we buy Apple, for example, at 160, and we buy 50,000 euros. So we don't want to lose more than 10,000 euros per trade, or 20% per trade, and 10% of the... No, yes, 1%. Yeah, that makes sense. So we don't want to lose more than 1% of our portfolio on each trade. So we must always put a stop loss in anything crypto. Crypto. The thing is that there is a problem with stop losses. And the problem with assets that are very volatile is that if you put a stop loss in an asset that is very volatile, almost certain the stop loss will be triggered and you will lose money. So in those occasions the stop loss tends to be put kind of much so that you need to lose more money. So that's why, again, it's another thing that volatile assets are not very appealing. But yeah, there we go. So don't lose more than 1% of, it could be of 1 million or it could be of 1,000. So it could be don't lose more than £10 on each trade. And then finally, how do you do that stop loss? Probably you can get some kind of tool, but remember this. So if I buy Apple at 160, let's say in this case 164, I need to get a price in which, or that is 20% below the price that we bought Apple. So for example, let's do 130 divided by 164 minus 1 times 100, and this gives me minus 20. So that is a good point to put the stop loss. How do we do it? There are various forms, and probably all the platforms work in the same way. But if we go to open positions here, and we go to Apple, add take profit, this TP is take profit, and this is stop loss. Take profit is kind of the same idea, but if let's say we don't want to make more money than a certain amount, which doesn't sound very good, so I mean I wouldn't worry about that take profit. But yeah, stop loss price 130. We would click here sell. I mean probably okay, let's do this. Let's put here sell, because this is just a fancy name of telling that platform sell all my Apple shares at 130 if Apple reaches that level. Cool. And finally, the very last slide. Thank you very much for coming. Have a very good Christmas break and good luck with your exams. I really don't want to think about the exams. Again, you can message me at any moment, Facebook or WhatsApp. You can talk to me now if you want. Look for possible trades, and see you at the beginning of semester 2. No idea exactly when. I don't know, could be first week of the teaching of semester 2. Could be second week of semester 2, something like that. You will hear from me. And that's it. Thank you very much.
Thank you.